Welcome to the new model, which is on capital budgeting and investment decision. Today, we are going to take our discussion on the time value of money to a real project situation, whereby organization budget for project activities that are capital intensive. Aspect of capital budgeting. By capital budgeting, we mean the process of planning and controlling investment for long-term projects. It also involves choosing amongst investment alternatives. In other words, what this means is that at any point in time, organizations are faced with different profitable and non-profitable projects. Even within the profitable project, organizations have to also invoke a sound investment analysis mechanism to be able to pick within those profitable projects those that they can embark upon at a time, giving into account the fact that organizations always face what we call the capital constraint. And at times also there may be a need for capital rationing. In other words, organization investment department may be subject to a budget ceiling for which they cannot overspend for a given fiscal year. Now, within the capital budgeting decisions, there are two fundamentals that we need to take into account of: the cost and the income. Income in the fact that the cash flow that organization may be expecting in the case of investment opportunities, as well as the costs that are related to the capital outlay that organization is going to spend at the beginning of the project. Now, in capital budgeting decision, we should be able to differentiate between those costs that are relevant and those costs that are not relevant. And in picking within the relevant and irrelevant costs, capital investment decision focus on those costs that actually vary across alternatives. Across alternatives make it relevant for a capital investment decision maker. Now, there are different stages that are involved in capital budgeting decision. One is for you to identify and define what the investment objective is. And defining the investment objective provides the investor or the capital budgeting analyst opportunity to search for those information and sieve within those information, those relevant information that may be necessary in taking investment decision. Now, in the search, you move to another stage of information acquisition, which means extracting those relevant information for the investment decision. After acquiring the information, the next stage will be for a capital investor analyst to actually select within the investment alternative using different sound techniques that either taking into account the time value of money or those who are risk driven. After selecting within the alternative, the next hurdle that the investor need to cross will be to actually determine what is the source of financing for the project. We have two different sources of financing. Organization can finance internally using their own money, or they can also take from the outside, which is an external borrowing, which incur a debt, and also the fact that organization will be committed not only paying back the principal but also the cost of those borrowings. So organization must take into account the leverage ratio as well as the optimal level of leverage they want to maintain in a given situation to determine the source or the combination of the source of funding that they want for a project. And beyond that is for implementation and monitoring. Now, having explained the various stages that are involved in capital budgeting, we will need to also look at the steps in ranking potential investment. As we have highlighted in the first paragraph, organizations are faced with different investment alternatives. It therefore means that even if you have to look into those ones that are profitable, there are multiple profitable investment opportunities that organizations face. So the ranking actually have to commence with looking at the value that are involved in an investment, which is for organization or for the capital budget analyst to determine the net investment cost of the assets or the initial capital outlay that is required. In order to determine what the initial capital outlay would be for a given project, organization will need to also consider those assets that may need to be replaced and also assets that the proceeds that may be coming from those asset replacement process. And in netting of that from the initial investment, you will be able to determine what the net investment is at any given point in time. And the next stage would be to estimate what the cash flow is. Cash flow vis-a-vis the inflow and outflow, as well as to relate the benefit of these to the cost associated with the investment. And then the final stage will be to rank the investments. The next stage actually we look at the capital budgeting techniques. For an analyst, you should be able to invoke different sound techniques in measuring the profitability or determining the soundness and the profitability of a capital budget decision. We have two groups, those called discounted techniques and those called non-discounted techniques. For the discounted techniques, the idea is that organization or the capital investment analyst is taking into account the time value of money in their decision making. And therefore, you have different mechanics in the capital budgeting that provides an investor or the analyst with opportunity in actually factoring in the time value of money concept. We have net present value, we have profitability index, we have internal rate of return, and then we also have a discounted payback techniques. In a new non-discounting technique, which is the second group of investment capital budgeting techniques, these are the groups that are risk embedded, risk driven. In other words, they actually mirror what level or what period it will take for an organization to recoup back the initial capital that is invested and be able to determine whether there will be any upside from such investment. And we have the two popular techniques there called payback period methods and as well as accounting rate of return. As we said earlier, the difference between the two groups of techniques lies in the recognition of the time value of money. Now this takes us to an exercise. A simple exercise in a capital budgeting decision. We look at the net present value concept. In other words, these techniques take into account what the time value of money is, realizing that the value of money today will be different with the value of money tomorrow. In other words, the value of money changes as time passes by. We have an example that said the company discount the relevant net cash flow using a hurdle rate of 6% if the initial investment amount to $185,000 and the forecasted stream of benefits from the next 3 years are $77,000, you should calculate what the net present value will be. Now, there are two situations here, and this gives rise to two methods in calculating the net present value. Net present value can be calculated looking at the factors from each year or each period within the total year given for a particular project. Or you can also adopt the annuity concept that actually combine those periods at once. So we can have two methods which we can quickly look at. One that actually consider each period. We can design a table that look at the years and then the expected cash flow from that investments and then the discount factors, and the last one will be the present value of those amounts. The year zero represents the year of initial investment, and we were told from the question, the exercise, that the company has an potential initial investment of about $185,000 and a discount factor of 1.0 because that is the first year, which is 6%, and therefore timesing the cash flow with the discount factors will gives us the same amount for the initial year. But for the subsequent year, we were told in the exercise that the firm is promised a $77,000 for every single year for the next 3 years as a stream of benefits. So here we have 1, 2, 3. And in each of the years, the organization is promised potentially from the project $77,000 every single year. Now, the next next stage will be for us to determine what the discount factor will be for each of the period, because the amount of money in year 1 in value will change as compared to the amount of money in year 2 or year 3, given the concept that we have learned from the beginning of time value of money. And from the question we are given, that the discount factor, this budget or this capital investment will be discounted as 6%. For the first period, 6% discount factor is 943. For the second year, 6% discount factor will give us 890 from the table we are given. And also, for the present value of the third year, it will be 0.840. And this is a typical way of determining what the present value will be. And the only thing you need to do is to times the cash flow by the discount factor, and you will arrive at a present value amount. And this amount are summed together with the negative and positive to arrive at what we call a net present value. A positive number shows that this investment is profitable, and a negative solution will show that this organization may likely going to incur a loss if they embark on this investment decision. Now, this is one concept of determining what the present value would be. If we have to invoke our knowledge of an annuity, we know that a series of payments for 3 years show and indicate that this is an annuity concept. And therefore, instead of creating a table, we can simply say that the value or the NPV from this investment is simply equals to the sum of the annuity, which in this case will be 77,000 times the annuity, the present value of annuity for the third period under 6%, which is simply 2.673, and that minus the initial investment from this project. And this, of course, will also arrive and give us the same answer as you have adopted in a table format. So you can have a line equation of the net present value, or you can simply adopt a table format of a present value. Irrespective of the methodology, you should be able to arrive at the same, at least at the same investment decision of whether to accept the project or to reject the project. And we have said that the concept of rejection or accepting of a project is driven by whether the NPV result is positive or negative. A positive NPV result indicates profitability, and then a negative NPV result is an indication that there is no prospects for the project in terms of future profitability. Now we'll go to the next unit, which is financing and capital structure decision. In the steps we have enumerated in a capital budgeting decision, after after deciding which investment alternative to pick, which result may be dependent whether you have used a discount techniques, maybe a net present value or internal rate of return or a discounted factor, or you have adopted a non-discounted factor of a payback period or an accounting rate of return, irrespective of the sound technique that organization have adopted. After picking an investment decision, the next order to actually cross will be to determine what will be the financing source of this investment. For instance, if we have arrived at a result that shows positive NPV and the organization want to go ahead with the project, then the next order will be, how do they finance the project? Because we have already know that this project initial capital outlay is about $185,000. So this unit 5 on financing decision and capital structure actually explain how organization mix up both their own money and other people's money, which is an external source of funding, in funding projects and business opportunities. Concept of financing decision. Financing decision relate to composition of sources from which funds can be raised to finance investment decision, as we have identified. And there are two sources that are basically prominent in the business world. Organizations can use their own source, internal funding in terms of equity, or a source from their retained earning, or an external source of issuing a debt or taking a loan from the financial institution. So the combination of these two sources of funding create what we call a capital structure for organization. It therefore means, for instance, if organization want to raise 185,000 and the firm actually decide that, okay, we are going to use our own money of 100,000, and then the remaining 85,000 will be borrowed from an external sources, which in other words still gives you the total amount. This in disguise create what we call a capital structure. Capital structure in the sense that this would be, for instance, 55% almost of, or 65% of the total capital, and this may maybe represent, let's say, 35%. But irrespective, this creates what we call a capital structure. And capital structure also is used to represent the proportional relationship between the debt in the capital structure, in the firm's investment capital, and their own equity that were raised from issuing an IPO or resulting from the return earnings from previous investment upsides. In overall, the goal for financing decision is always to ensure that you pick a capital structure that maximize or enhance the shareholders' value. At any point in time, the shareholders always favor those investment decisions that increase and enhance their value. Rudiments of capital structure. Every sound capital structure that a firm adopts, irrespective of whether they have more of equity or less of equity and more of debt, or more of debt and less of equity, are driven by some fundamentals. Fundamentals include the profitability. The capital structure of organization should be such that it should allow them to make more profit. It should ensure that they are always solvent in the fact that they should be able to meet their future obligations long term and still continue in business in long term. And also, it should be a capital structure that allow them flexibility. There are some capital structure that if you are highly leveraged, if you are owing more, debtors or venture capitalists will begin to dictate the kind of investment decisions you will be able to make, which also create a problem, fundamental, which is the last one, of control. And then the last point will be to be a bit conservative. It's good to be optimistic, but also to ensure that your debt at any point in time within the capital structure should be at a manageable level. Then we have an exercise, a simple exercise that tries to depict what the capital structure decision is. And in a capital structure decision, or financing decision as it is popularly called, what matters in those two decisions is the ability to maximize the shareholders' value. And how do you maximize or show that you are maximizing the shareholders' value? They are always indebted or entrenched in the earnings of the shareholders. So one of the basic parameters used in determining whether organization is enhancing the shareholders' value or not are usually the earnings per share in every investment or earnings that the company generates from their activities. So we look at a typical capital structure example to depict what we mean. This next exercise, this says that suppose a new firm is being formed and require an estimated $500,000 investment. Remember, it's a new firm and they required $500,000 investment dollars. The management of firm is expected to earn an earnings before interest and tax, which is EBIT, of $120,000. The firm is considering two alternative financial plans, either to raise the entity funds by issuing 50,000 ordinary share at 10 naira, or the second part would be to raise 250 by issuing 25,000 ordinary shares at 10 naira and also borrow the subsequent remaining balance at 15% interest rate. So there are two opportunities here, two plans here. One, plan one did mention the fact that organization can actually raise this $500,000 by issuing 50,000 ordinary shares at $10 per shares. And if you times 50,000 times 10, that gives you the total amount that they want to raise, which is $500,000 on that first plan. The second plan offers two alternatives in one. One alternative would be that they should issue 25,000 ordinary shares at $10 per share, which gives you $250,000. And then they can also borrow, which is a debt now, of 250 from a bank, but this will incur an interest of 15%. But irrespective, when you add the two together, it still gives you the amount that they want to raise, which is $500,000. The question now is, which of these financial plan is the most optimum financial plan in this investment situation? The question we normally ask, the question that we ask are usually answered by which of the alternatives actually enhance the shareholders' value. And we can depict that in a table that shows the two plans and provide an analytical process to determining which of them impacted positively on the shareholders' value. So we have plan one. Plan one, we have explained what it is, and then plan two. Now, the first thing is to determining what our earnings before interest and tax is. And we were told that earnings before interest and tax for the two financing alternatives will be 120,000 equal. So the next thing we need to do is to provide for the interest. What is the interest that each of these alternatives is facing? There is only one alternative facing interest, which is the loan that the company wanted to take of 250,000 to make up the 500,000 under plan B, which we were told that is 15%. Which is 15%. Now, if you determining what the value of that is, of value of 15% of 250, that would be what will be under the interest rate chart. And then you provide for another, that will now gives us earnings before tax. And organizations are faced with the corporate tax, which we are told from the answer that they have 50% corporate tax. 50% corporate tax. And that 50% corporate tax will be charged on whatever the earnings are before taxation. 50% of it will give us what the concept, what the tax rate will be. And then at the end of the day, what you will have is what we call earnings after tax. The earnings after tax. And these earnings after tax are more or less that called a profit that is available to the shareholders. And each of these elements will now be subjected to analysis of how they impact on the shareholders' earnings. And how do they impact? One of the basic way of determining how each of them impact on shareholders' earning is the earnings per share. And earnings per share of shareholders are calculated as the profit after tax that divided by the number of shares. Under plan A, we have 25,000 ordinary shares. Under plan B, we have under plan A we have 50,000, and under plan B we have 25,000 ordinary shares. And at the end of the day, whatever you get under each plan in terms of dividing the earnings after tax by the number of shares outstanding is what will determine which of the two alternatives best actually enhance the shareholders' value.